Hello, everybody, and welcome to another episode of the Investing Education Academy podcast. This time, we are going to talk to you all about some of the things that we've learned since these rate hikes have started to occur. And for those of you all who have signed up recently, I wanted to thank you all for becoming part of our community. For everybody who's been thinking about becoming a member inside of Investing Education Academy, please do it. We're growing. And the cool thing is, we just got a client, somebody who's working with us, and they were a Marvel actress. We can't say exactly who it was, and they're working on a new sci-fi. I don't know how much we can say, so we won't say too much. But it's really exciting that we have some big names starting to hit us up about looking at their portfolios. So if you guys are spreading the word, we thank you. It's definitely starting to show. People are coming to us individually, asking us to look at their portfolios. So that's really pretty cool. So with that being said, Leon, can you tell everybody why we chose this topic while I do some homework?
Now it's homework, not housekeeping.
Oh yeah, housekeeping. That's the dad in me. So it was
right. All right. So the topic today is what we've learned since the Fed's historic rate hike last week. And the reason we're calling it historic is because this is the first interest rate hike the Fed has done. Let me say the first rate hike they've done since 2018. So that's not really historic. That was only a couple of years ago. The reason I'm calling it historic is this is the first rate hike the Fed has done when we've had runaway inflation since the 1980s. So we're talking 40 some odd years ago. I think it's like 42 years ago was the last time we had the environment of runaway inflation. Like, inflation right now is like 7%. So the Fed is now raising rates in that environment. So that's why it's historic. And so the interesting thing was, okay, how is the market going to react, right? Because as we all know, especially those following IA since November, end of November last year, we'll keep tooting our own horn here. We said the S is about to hit the fan. Like, you've got to get out of low, high valuation, non-profitable stocks because this is about to get crazy. And it did. Stocks like that, the ones that were the winners in the 2020, 2021, are down anywhere from 50 to 90%. So we kind of knew that was going to happen, but that was like on the word of what the Fed may do. We had no idea what the rate hike was going to be. We had no idea how big it was going to be. We just knew the rates were going to start going up. Well, now we have an actual rate hike in hand. They raised 0.25% last Wednesday. We go today. And the question then was, well, like, how will the market react? So last week, we're not going to go too deep into it, but last week we covered what they did, how it would affect your money, and how it would affect your portfolio. So if you're interested in that, check out last week's podcast. But this week, I want to go over what we learned, right? So what we've learned, I forgot to bring some here. Sorry. I have my notes. So what we've learned, so what happened since last week, interesting kind of factoids are that, so, leading into this, we'd always been saying how, this is going to really affect the stock market and it can be negative, yada, 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 right? Well, interesting thing happened, right? So the market is, again, you never know what the market is going to do. So since the Fed rate hike last Wednesday, just 1 week ago, the NASDAQ, which is essentially tech stocks, is up 8.3%. And the S&P 500, which is kind of the stock market in general, is up 5.4%. So what does that mean? What that means is, actually, we don't know what that means because no one can predict the future. But in the way it's kind of telling in that the market divested all of the air came out of the market prior to the rate hike, right? So November, we got the announcement, and we all know the market has tanked. The NASDAQ was down 20% from November through March, 20%. The S&P 500 was down a little over about 10, 12%. So the market took a crazy, crazy hit towards the end of last year, into this year. And so when the rate hike actually happened, everybody was like, well, what's the market going to do? The market actually rose, right? That was not expected. People thought, okay, when the Fed actually makes the rate hike, the market will take that negatively, even more negatively, and probably drop even more. That did not happen. The reason it did not happen, people speculate, because again, nobody knows for sure, was that there was this notion that they may raise 0.5%. versus 0.25%. So they only raised 0.25%. The market took that as yes, they're not going to raise rates a lot. We can run for, the market can take off again. But a funny thing happened after that. So Brent, do you remember if I mentioned this last week? I remember talking about this, but I don't know if I remember mentioned it last week. I don't know how I could have, because it was the day of the rate hike. But Jerome Powell, the day of the rate hike, said that if they need to, they will raise
based off conditions at the time.
Right, but so what happened then? He said we will raise more than 0.25% if we need to, right?
If we need to, yeah.
Yeah, but nobody cared, right? Like the market just totally brushed that off and said, we don't believe you, so therefore you're gonna stay at 0.25%. We're off to the races. Well, he came out, it was either the end of last week or early this week, and drove that point home. Like he was like, look, y'all didn't believe me before. I'm gonna tell you again. We will raise more than a quarter point rate hike if we need to. And since he said that, the market has kind of pulled back a bit, right? And so the reason the market does not the market's okay with rates rising, because we've seen since the rate hike actually happened, the market is actually up. And we showed in the past that the year when rate hikes happen, the market actually outperforms usually. But the problem is when rates rise too fast, right? So when rates shoot up exponentially, the market loses its mind, right? Because then all this money, because remember, when rates rise, people are going to start moving money around, buying bonds, selling tech stocks, buying cyclicals, things like buying value stocks. It's a whole bunch. It's just a big game that goes on when rates rise. So when they rise really fast, the market loses its mind, and all this stuff has to happen, and there's all this crazy volatility. When rates rise, relatively slowly, the market can handle it. It can digest that. So raising 0.25%, the market's like, cool, we like that. We're totally fine with that. It's when they go above 0.25%, 0.5%, maybe even a 4% raise, that the market will start to lose its mind. So when Powell came out either end of last week or early this week and just reiterated that point, like he said it over and over again, he was really trying to drill this home. We will raise rates more than 0.25% if we need to. We need you all to know that. So what everybody thinks that means is the next raise is in May. Everyone pretty much figures now that they're going to raise 0.5% in May. The market's not going to like that. Okay, I'm gonna let y'all know that now. Even though he's telegraphing it, saying in May all he's saying is we may raise 0.5%. But the market is saying if he's saying that, they're probably going to do it. So if they raise 0.5% in May, expect volatility. Expect the market to drop, drop, just all types of craziness. Because again, that's rates rising relatively fast. And there has to be that's a whole other game that big money plays when rates rise faster. So recap, what we've learned since the rate hike last week is that the market digested 0.25% pretty good, because the market is up. NASDAQ is up 8.3% since then. S&P is up 5.4%. But when Jerome Powell came out and said, hey, we will raise more than quarter point if we need to, and he said it over and over and over again, kind of preparing the market, people are now speculating that they'll raise 0.5% in May. The market will not like that, even though he's telegraphing it. If that happens, I suspect there'll be a lot of downward pressure volatility if that happens. So that's what we've learned in the week since that. So what we're telling you all this for is just be prepared over the next 2 months. We could probably see more upside because again, nobody knows what's going to happen. But if that rate hike of 0.5% happens in May, a lot of that could be taken back. So just an FYI for our community.
Yeah, and any of y'all looking at this, a couple weeks back we talked about the buying opportunities with some of these stocks that actually are producing profits. And you've seen that these stocks, when we did see some stabilization, even I would say some of them started to pull ahead. Normally, the ones that pulled the hardest, the fastest, and with the biggest recovery to close to where they were at highs were the big names, the NVIDIAs, the Microsofts, Tesla's knocking on 1,000. So I was like, whoo, whoo, whoo. I mean, but
and remember a couple months ago, you were like, whoo. You said you almost hit the button.
I almost hit the button.
But you was like, nah, I'm gonna hold on.
I almost hit the button. But I mean, looking at the Googles, looking at the Amazons, these companies have seen the fastest recovery. The ones that you don't see are like the Gooder RX. You're not seeing. I mean, some of it was. What is it? Activision Blizzard, like it didn't run like people thought it was going to run. When you look at what was it? What is the company, Leon, from the CRM company?
Sure. You talking about
The symbol of CRM.
Yeah, Salesforce.
Yeah.
Salesforce.
So
Yeah.
you didn't see that run. And
Right.
the thing is, you're thinking of, well, like, why? Why is this happening? A lot of those dollars in those, some of the other companies are number one, not profitable. And then the others are using the money they have for acquisition. And so that money isn't liquid. And so Wall Street and investors are looking for companies that have real money on their books. But why is that important? Why is that something that we learned? We learned during the pullback that the market tends to go bottom left, upper right. We learned that we have to stay the course just like everybody else and make decisions that are smart, not really emotional. We learned that just like everybody else, you have to be willing to put yourself out there and ride these highs and these lows. So Leon made a reference to the fact that I was last year, not a couple months ago, I was basically like jittery. I was like, oh my gosh. So, Tesla is a huge position, and it went down to maybe 750.
Yeah, it was like mid 700.
And I think you all know, if you're part of Investing Education Academy, I was like, I might sell it. And if you also know, if you're part of Investing Education Academy, I put out a thing. I said, pray for me. I'm buying more. And I bought some more. And I am really excited that I did that now.
So far.
Yeah, like so far. But however, understand, I am prepared for the market to go back down for Tesla in particular. I'm talking about Tesla right now. If it goes back down to the 7s, maybe even brushing against 6, as these other American car companies are starting to produce some pretty exciting EVs, the competition is getting very real for Tesla. However, personally, I don't look at Tesla like a car company. I'm looking at the technology that they have and the innovation that they're looking at. That's a whole nother meeting. But the bottom line is we learned that you have to stay the course. We have to stay the course. We also learned that some of you all are probably really, truly, truly going through an emotional state right now. Like, screw this, I'm out. If you are that person, go back to our podcast. You can find it at IEApodcast.com. We talked about what happens when you miss 10 of the biggest moves, 10 days where it's the biggest moves in Wall Street in a given year. We even did it for a 10-year period. This is that moment. If you miss being investing, I'd say the first 2 days of this week alone, you probably lost in value. And I don't know everybody's portfolio, so this is very general. Maybe like 15%. Getting back 15% that you lost just by not being in the market like 2 days of this week alone. And you're thinking, okay, well, if you guys are saying the market's gonna go back down, what's the big deal? The big deal is some of these companies have made major announcements in regards to what they're doing, splits, acquisitions,
buybacks, raises.
There's partnership agreements in place, and so they may not go back to all these lows, which means you capture the loss and you're not even experiencing the gain, and you're still playing that double dutch game. You're trying to figure out when to get back in, and you're listening to all these gurus on social media who are telling you the exact number you need to get in, and just because you think and you hope that they're right, you're willing to go with it. Hope is not a strategy for success. Timing the market is going to lose when compared to being time in the market. It's evident. Like, this week has shown that we all got punched in the face. And this week, I'm not back to where I was last year, but it was a very nice game. It was happy to see. So
yeah, for me, just a number on that. So over the last week, I'm up. So from last week to this week, exactly week, I'm up 32%. Now I'm not back to anywhere near my all-time high yet, because the market is still down. We've only gotten back. So just using broad terms, remember the Nasdaq was down 20%. This week it gained 8%. So the Nasdaq, which is generally tech stocks, which a lot of us are in, is still down 12% for the year, right? So I'm not, so just extrapolating that out to my account, I'm still not back to normal, but I'm up 32% relative to last week. Had I pulled out and just said, "Oh, the hell with this, and this game is rigged, and I'm done with this," I would have lost a massive gain, right? But I gained 32% last week, and during that week I was buying. Last week I did quite a bit of buying into some stocks I already had and into some new positions. So and that helped me gain 32%. Now, if we go up another, 3, 4, 5% the next week, or maybe the following week, I can gain another 10, 12% maybe. So like Brent said, we pointed this out last year. We actually did a live on it. They, like I said, if you miss those big days, those big recovery days, you can actually miss out on most of the gains of the year. And we also point out how those big recovery days typically come after the huge down days, as we saw. This week we're up, Nasdaq's up 8%, right? The market was down 20% over the last couple weeks and months. So had you pulled out during that 20% drop, you locked in losses, and now you're scared to get back in. And that's a tear. I've been there. Brent's been there. We've all been there. Like that horrible position when you sell and then you see the market shoot back up. Like that's the worst feeling in the world. But we've learned not to play that game. We stayed the course. Like we said, bottom left, upper right. We're in this thing for 10, 20 years. So we hope most people watching this are too. So you got to remain in. You got to stay strong. You got to know that again, especially in the U.S. economy right now, we're going through external threats, the war, COVID, interest rates, the whole. Like I said, the market has never been faced with so many external threats than it is right now in the history of the market. So we're all suffering. I mean, Brent and I are too. We're down quite a bit from our highs, but we know how to play the game and run it out.
Yep. So for everybody, we really thank you for being with us. We're going through it with you, but this is a great example of what happens when you get on the sideline. Like, I'm just going to wait till the bloodbath ends, because the reality is when people come out with the to help, where are you? You can't, you're not there. So hopefully you stayed the course, but also don't buy crappy stocks right now. If you are speculative, let's talk. Don't get into the speculative stock game. Don't hope that these stocks that got demolished will come back. Some of them will disappear because this inflationary period is going to go for a while. So again, this isn't the time to go, okay, let me start day trading again. I personally, again, there's somebody out there who has mastered it and they're killing it. Congratulations to you. The average individual should not be playing a day trading game in this type of marketplace. It will catch up to you. So,
and just show the longevity of how long this could go. Economists are speculating that inflation. So right now we know rates are rising, but inflation rates right now, we'll just say, are 2% interest rates. I'm quoting the 10-year Treasury. Inflation is 7% right now, right? So that's a net negative 5% that you would earn on your money if you were invested in something that earned 2%. Economists are betting or expecting that by the end of next year, we'll still have negative real rates, meaning that interest rates will still be lower than inflation. And so what that means is your money has to remain out of these interest-bearing accounts, savings accounts, checking accounts, things like that, because inflation is going to continue to eat away at these rates. And there's actually speculation right now. I heard today that typically inflation has been 2 to 3% for the past 50 years on average. They're saying that could actually rise and actually become more like 2.5, actually 2.5 to 3%. So instead of being 2 to 3%, it actually can rise. They're saying it may rise at 2.5 to 3%. So that's a half percentage higher in yearly inflation. They're kind of expecting, depending on how this whole supply chain works out. So in the future, inflation could generally, on average, be higher than it was pre-COVID. So again, we need to have our money working for us in accounts and in assets that will earn more than inflation.
Yep. And for anybody who's inside of IAA, know that we have we're working on something in the real estate marketplace that will be pretty exciting if it happens, when it happens. But we're always working on new ways to present ourselves. And for all of you all who have been like, who are these Portfolio Panthers and what do they do? We actually are releasing a website for the Portfolio Panthers, and we're moving that group to kind of having a VC feel to them. So we're going to be making some major investments in companies in addition to other investments in raw land, buildings, and the such. And so far the property, one parcel of land that we bought has appreciated over, hold on, Leon, if it went from, it's like over 20%, it's like over 25% appreciation in less than a year. So
Yep.
it's less than half a year, I believe. But either way, that's amazing because when everybody else is looking at what's happening in the market, we're diversifying our investments. So if you are interested in becoming a Portfolio Panther, right now, the Portfolio Panthers are $5,000 a year for membership. More than likely, within the next couple months, it's going to be $10,000 per person per year. And we only have three or four slots left at the 5,000 mark. So if you are interested in investing with us and becoming a IA Portfolio Panther, we highly suggest. One of the companies that we have just did a deal with Kevin Hart and Mark Cuban, which we are super excited about. But we were investors before them. How about that? So that was pretty cool. There's been a lot of good stuff happening. We really hope that you all take the time to really investigate all the offerings inside of Investing Education Academy. Leon and I say this all the time. It's not a threat, and we don't say it to make anybody feel bad. We are going to continue to grow regardless. We just hope that as many people as possible can take this ride with us. But it's not for everybody. Some people really like savings accounts, and
not a good place, not a good place to be. But we always say this: if you can sleep at night, that's really what matters. But just know that it's not helping you, not helping your family to grow their money, to grow your money, in the future. Like you said, I mean, Panthers is one thing. That's a whole kind of a separate thing. We have, of course, the membership platform. We do a lot of research on stocks and on cryptos that we provide for the community. So that's another avenue too. But again, if it's not us, find somebody out there. You gotta get out of your own head. Find other groups on Facebook. There are a lot of things on Instagram. There's a lot of places to go to get resources, to find information. But we've learned, Brent and I have learned that if you sit in your own head and try to figure everything out on your own, you'll never really be successful. Very few people can do that.
Yeah, we've been in the game 25 years, and we still call each other when we're just thinking through like issues, and we still bring stuff up to each other that the other didn't know about. Like to this day, we've known each other for 35 years or something. So it's really important that you don't keep recycling conversations with broke people. And I hate to say it that way, but I see a lot of people who are all in the same financial boat talking to one another about how to get out the boat. I'm like, how I want to talk to somebody who's already out the boat and built a bigger boat. I want to talk to people in the same boat. So
and just last point on this is right now I'm conducting some research for something that I'm working on.
Can we tell them what it is?
Not yet. No, not yet. No, we'll get there. But that I'm working on, and so I did an interview. Well, I'm doing research with investors, and one of the people I talked to is a member of IA. And she said in our kind of back and forth, one thing she loves about IA is the fact that she has a resource to go back to bounce ideas off of, answer questions, to just kind of get a feel for a particular stock or a particular investment. Again, find out things that she does not know. And that was one of her most favorite things about IA, was having that community aspect. So, like I said, if you join IA, great. But if not, find a community somewhere to, like I said, get out of your own head and get ideas from other people. Because we all nobody knows everything.
I can't say anything about a tech startup.
No.
Okay, cool. All right,
we're getting there.
I won't say anything about the tech startup. So I will completely shut up. So for everybody out there, we owe you all two things. It's the stock picks or cryptocurrency picks. So for those, you can go to Investing Education Academy on Facebook to our group, or you can go to iamembers.com. And once you get into the membership platform, you can not only see both stock picks or cryptocurrency picks, but you can see our ongoing list of all the picks we've made since we've started, which is a pretty extensive list. And not everything on there is killing it. But I'm not going to bring up anything with a possible startup company launching. And I'm not going to bring up anything about the fact that we now have Marvel actors contacting us to look at their portfolios, which is awesome. But I will bring up the fact that you can join IEA still. We hope you do. But if you don't, we're going to keep going. So everybody, thank you for being with us. We wish everybody the best. It's going to be rocky. We're in it with you. Stay the course. Talk to us. Send messages. And keep investing.